Hello, oracles. Well, do we have a recession coming? Chances are yes. When is that going to be coming? Nobody knows. But today we're going to discuss some of the signals and signs that we have out in the market right now that are kind of indicating that we possibly have one coming maybe soon. And when I say soon, nobody knows. Maybe it's 6 months, 12, 18 months. We shall see. But historically, we always get into a recession at some point. We have seen in the past, it's about every 10 years or so, we go through a very difficult economic time. We've had the late 80s with 1987. We had the dot-com bubble in the early 2000s, had the housing market recession in 2008. We did have that big dip when we had COVID, but that was a very short-lived dip that was kind of manufactured, and we came out of that really strong. So we really haven't seen another one of those, but is that one going to count? Again, nobody knows. So today we're just going to discuss some things that are we going to get one? What are we going to be getting soon? And you guys can leave your thoughts in the comments below to let me know what you think about all the data that's out there right now. And does it mean that we're going to continue running into a bull market? Or do you think we're going to see a massive pullback and maybe even a bigger recession? So if you guys would do me a favor, hit that like button down below and we'll get right into this. All right, so first off, I'm going to start off with why I think we are going to see a recession coming and what I think the catalyst is actually going to be. Now, personally, I do think that we are going to be getting one relatively soon. Now, of course, we've been seeing a very booming market lately. It's been going crazy. I mean, basically, since the end of October, we had that little bit of a dip in March, but otherwise, I mean, we've basically been running straight up since the end of October. So, we're kind of due. Typical bull runs run like 7 to 9 months or so, and then you get typically a pullback of some sort. Maybe not a full bear market, but you might get a 10% correction just to clean things up. We got a little bit of that again in the March, April timeframe, but it really wasn't all that noticeable. So I think what we're starting to see in the data, we see inflation staying relatively high. It's not going back up by any means, but it's not getting pushed down by the interest rates as much as the Fed thought it was going to be. So we still have that relatively high. And we started to see a little bit of the unemployment start to creep back up a little bit more. Again, that hasn't been going up too high too fast, but starting to see some signs of that creeping up. And typically, once you start that ball rolling, it can move relatively quickly. So some of the signs that I see are the fact that small businesses are what really run the country. That is the backbone of this country is small business. We talk about the mega caps all the time. We've got, all the magnificent sevens, Nvidia, Apple, Google, Microsoft, Amazon, all these companies out there we talk about regularly, other big companies that are out there as well. But it's the small caps, the smaller companies that are out there that are really driving business forward. Well, right now, sentiment from smaller businesses is really low. They're not very happy right now. If you look at the Russell right now has been hurting for the last 3.5 to 4 years. Some people are out there thinking, oh, it's due. They're due to make a big pop. They're going to come back up. Tom Lee is saying, hey, we're going to see a 50% run in the Russell. Maybe we do, but let's think about why we've seen small caps hurting so bad over the last 3 to 4 years. Who got hurt the most during COVID? Small caps. Businesses got shut down. They got closed. People who didn't have the cash to float by went out of business. They didn't make it. Smaller companies just struggled to get through this. Then inflation hit. Guess who also didn't have it? So if they were able to use that cash to get through COVID, now they've got to pay higher prices on everything because inflation has skyrocketed. Now, with the depleted cash they have, they've got to take on loans at higher interest rates. Guess what else went up? Wages. Wages went up. So now all of these companies having to pay their employees even more money are losing all of that spending power that they had. Now, you start to look at the fact that businesses are starting to struggle with this. And if inflation isn't coming down and interest rates have to stay higher for longer, companies who are trying to hold out for interest rates to come down to get loans no longer have that option. Now they're going to have to make that choice. Do we cut payroll? Do we cut back? Do we close the doors? We don't know. So now we're going to see that unemployment cycle start to spiral because of the small businesses. Small businesses start to go out. That is going to cause unemployment to go up. Guess what else happens? We start seeing prices coming down. We've already seen with a lot of these companies, McDonald's, we've seen Starbucks, we've seen a lot of these bigger companies who normally don't advertise deals or specials or things like that are starting to do that more often. We see Targets, Walmarts, all these other bigger retail box stores out there starting to cut prices on a lot of their products. you're seeing these prices coming down. That again is going to hurt the smaller businesses who need that revenue coming in. So if customers are going to go to small businesses and say, "Oh, well, I can buy this over at Target for, $5 less," they're going to go and do that. Now, small businesses are going to have less income coming in, less money to pay payroll, then they're not going to be able to hire people because they don't have the money to pay for them. That now leads to more unemployment because companies are going out of business. Now, when we start looking at those bigger companies who are cutting prices, they cut prices. They've got to answer to the market. They have to answer to their investors. So if all of a sudden they're going to be cutting prices on things, that's top line revenue. How are they going to compensate for that cut in top line revenue on their bottom line? They've got to cut expenses somewhere. They're going to be cutting expenses from payroll because payroll is the number one expense. They're going to figure out how to get more lean. AI really has not turned that corner yet to become a functional asset to a lot of these companies yet. Some aspects, yes, but not enough to really cut that massive payroll when it comes to like a Target. Sure, you've got self checkout, but how much self checkout are you going to have? Everybody? We might get to that point. Who knows? I mean, McDonald's is now to that point where they have you go in and you put your own order in. People are basically not even taking your order anymore. They read a screen, they come out and they hand it to you. But we're going to see that when it comes to the bigger companies that are going to start cutting payroll because they need to meet the bottom line dollars for their investors. So in turn, we're going to see unemployment going up from all these larger retailers as well. That is just going to keep that spiral going. When this is going to happen, I don't know, but we are already starting to see the signs of that coming through. Now, we also have an election year. Typically, in an election year, it's actually a positive year in the market for the entire year. So we have gone up quite a bit since the beginning of this year, but every single time we get to that September, October timeframe, the market does a big pullback because of the uncertainty of who is going to get elected. So we're most likely going to be seeing that. But when does it start? We don't know when it starts. Maybe we do continue this boom into the summer. Maybe we get to that July timeframe and then we start to cool off, and that August maybe starts to kick off that downward spiral. Again, timing of it, I don't want to time the market. That's not a thing that I'm going to be doing. But just seeing the signals as to when this is going to happen tells me I need to do something to prepare to get ready for this. And so what I have been doing to prepare for this is I've been building up my cash stockpile. So I know I haven't been on here in a while. I apologize. Life is extremely busy. My son is graduating high school this year. So I've got so much stuff going on with him. And honestly, I want to spend as much time with him as possible. The reason I'm investing is to get back as much time as I possibly can. And I'm not going to sacrifice the time to spend with my son to do this. So I apologize to you guys, but yes, he takes priority. So we're going to do that. I'm going to take care of him. And then I'm going to build this up because I want to get to a point where he doesn't have to make those decisions about work in the future, where I'll have an investment portfolio set up where him, my grandchildren can all take this and say, hey, do I want to work? And I still want them to work. I'm a hard worker. I want them to have that same work ethic. And I know all of you are the same way. It's important to have a hard work ethic, but it's important to work at the things that are going to be important to you versus important to someone else. I say it to everybody regularly, I want to work hard to live my dream, not help someone else live theirs. So that's what this is all about and why I'm investing. But I'm building up my cash stockpile right now so that I will be able to take advantage of this recession when it does hit. I know it's coming. So I'm not selling anything off. I'm just taking my dividends right now. But I'll quickly go through what I'm doing with my portfolio and all of my patrons. And thank you guys for your patience. I've been slacking over there on Patreon as well, but I'm going to try to get better every single week of updating this. I update my finances every single week when I've got the time. And I update my portfolio regularly. So right now I've got Coney, QQQY, JEPY, KLIP, and WiMAX. So these here, while I know could potentially have some NAV erosion to them, I'm still very positive on all of them, and they're generating some significant income. So they're pulling in a little over $300 every single month, which I take that and put it straight into cash. So I'm saving all of that. Everything else except for TLTW right now, I'm also putting that into cash. But once I see the interest rates start to come down, I'll flip that around. But until then, I'm dripping everything else in. So I'm generating almost $500 a month in dividends right now. So that's some significant income that I'm going to keep building up. But again, my cash, I now have almost $2,000, which is almost 3% of my portfolio. And I also have cash outside my portfolio that is bringing in 5% interest. So I'm looking to get my entire cash position to about 10%. Right now, it is just over 7%. So I'm going to continue building this up. And then once I get over 10%, I'm going to start looking at my positions and seeing what's the weakest. So I've been building this up as a very balanced portfolio. I'll break this down for all of you guys in a later video. But looking at like my individual stock holdings, I have about $400 in each one of them as a minimum. Some have dipped below, but I'm not adding to these yet. Again, if I think we're going to be getting into a recession, I think we're going to see some bigger sales going on and have a lot better opportunity. So until I get myself to 10% cash, I'm not going to touch any of these. I'm going to leave them as is, going to let the drip take effect. And then what I'm going to end up doing is once I go over 10%, then I'll see what's been hit the hardest, like a cat. I'll take a look at these and say, all right, is it still in a position? Is it still doing well as a company? And as long as the fundamentals are still strong in the company, I'll start building those positions back up. I'll just go by adding to the weakest because the weakest are typically the ones who are on the biggest sale. So, I'll do some deeper fundamental analysis on them before I just pull the trigger on it. But, knowing these companies are good companies, I'll feel secure just adding money to it little by little as we go on anyway. So my total portfolio right now is just over $66,000. That includes the real estate on the house that I have right now. And the house that I have right now, I am also working on. And so that was the big investment that I made. And also part of the reason I haven't been able to come on here is because I recognized what was going on. And you guys know I love my Tesla stock. I am still a big Tesla bull in the long term. Just think that, we've kind of seen that. And I called the 146 gap getting filled. Sure enough, it got filled. We bounced up. And now where do we go from here? All the Uber bulls were getting super excited about it when it was pushing up near $200 with AI day announcement and after earnings. That was awesome. I was super excited, but I wanted to make sure I was also realistic, understanding what was going on in the macro economy, because at the end of the day, the macro economy is going to rule the day. So it's going to end up running whatever's going to be going on. So even if interest rates come down, Tesla may still struggle if we're expecting a recession and the rates are coming down because of recession. Now, if the rates do start coming down without any recession reasons, then we're going to see them come down very slowly. It's not like the Fed's going to be cutting 1 or 2%. You're going to see 0.25%, 25 basis points, maybe 50 basis points. It's going to be very minuscule, not something that's going to cause Tesla to skyrocket. So again, I still think long-term company's amazing. I will be adding more to my position as time goes on. However, right now, for what I'm doing in my investing, not the best move for me and what I'm doing. So I took that money, I bought a house, and now the house I'm looking to generate income. So I'm looking to generate some income, and I am going to go Section 8 because who loves government money? I mean, I give them tons of my tax dollars anyway. I might as well get something in return. So I'm working on that right now. Have a couple little things left to do for the house. Going to try to get that on the market to rent in the July to September timeframe. Once that's done, that will offset my mortgage pretty much entirely. So if that is offset entirely, I'll have significantly more money to be able to invest back into the market. And right now, I've basically been putting in like $75 a week into the market. It's kind of where I was when I first started investing. I was doing about $10 a week. Now I'm doing $75 a week and cut way back. I was around $350 before I bought the house. But after I get a tenant in here, I can push that back up to about $500 a month. And that's going to be significantly more, especially if we get to a point where we see a recession coming in and we have a lot more buying opportunities. I've been speaking about it all last year, and you guys who have been with me since then know that I've been talking about cash flow generation is going to be king. Cash flow generation, cash stockpiles. Cash flow generation for me was more important because my stock portfolio was small. So I figured I could just keep adding and I didn't need a cash pile because my cash pile, as you saw, of my portfolio is $2,000. Not huge, not going to make a major impact. But if I can generate $500 a month in dividends and $2,000 a month in income from a tenant with rent, that is cash flow generation that I can use to really take advantage of the market. So that's what I focused all of my energies on. Now I'm getting back to everything here, and I'll explain to you guys more in the future. Just want to do a video to appreciate all of you guys and thank you for your patience in letting me go through all the things I was going through. And I'm going to try to get out a couple of videos a week for you guys going forward. I'm going to do my best. My son has 2 weeks before graduation, a lot going on. Got to throw a graduation party for him at my new house. Very excited about that. So all those things going on, but I'm going to try to get more information out to you guys, my thoughts on the market and what I've been doing. And I have seen very good success from this over the last 8 months. And I'm going to try to share more of that with you guys. But the big takeaways are still cash flow generation, cash stockpile. I'm getting ready for this recession that I think is coming. And even if I'm not right on the timing of it, we will always get a recession. If I miss more upside, so be it. But I would much rather miss a little more upside and be ready to catch that lows. I mean, that's basically what Warren Buffett does himself anyway. He buys things when they're on sale. So I'm waiting for that moment, but I'm still invested in the market. So I'm not missing out on a lot. I'm still doing well. And I just worked on the cash flow generation instead. So that's all I've got for you guys today. Thank you so much for everything. Leave your comments down below as to whether you think we have a recession coming up or if you think this bull market is going to continue running. I will see you in the next one.